Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to analyze S&P Global Inc., ticker symbol SPGI. I will explain why I believe S&P Global is still one of the best dividend stocks for long-term investing. It's actually one of the few stocks outside the tech sector that I like the most. Just to give you more context, at the time of making this video, the overall market is still in a major correction, largely because of Donald Trump's trade war and reciprocal tariffs. Most stocks, especially tech stocks, are still down more than 20% from their recent highs. The Nasdaq 100 has also decreased a lot from its recent peak, and many stocks remain oversold and deeply undervalued now. As for S&P Global or SPGI stock, it's still down quite a bit from its last peak. Many investors do not know this. S&P Global is the majority owner of the S&P Dow Jones Indices, which owns the S&P 500 index. This is a huge competitive advantage for the company because the S&P 500 is the most popular US equity index and benchmark in the world. Many ETFs, mutual funds, and even hedge funds use the S&P 500 for benchmarking or to create their own funds that track the S&P 500. More on this later. So in this video, I will explain why I believe S&P Global SPGI is still one of the best dividend stocks for long-term investing. You will learn about S&P Global's biggest risk, its long-term growth prospects, expected growth rates, and its intrinsic value. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing analysis videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic value models for all the stocks I'm analyzing. So you'll know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before diving into S&P Global, I want to explain why I believe the market will continue to recover going forward. At the time of making this video, Trump's trade war remains the biggest headwind impacting the entire US equity market. I've been saying this for a while. Without Trump's trade war and reciprocal tariffs, we will still be in a bull market at least through this year. Here is the important point you should know. Initially, Trump threatened to impose high tariffs on almost all of the US trading partners. His goals were to reduce the US large annual trade deficit, bring manufacturing back to the US, create more jobs, lower interest rates, and generate additional revenue for the US government to help pay down the national debt, which now exceeds $36 trillion. Trump also wanted to fire Federal Reserve Chair Jerome Powell because Powell refused to lower the Fed funds rate. Trump's trade war and reciprocal tariffs will likely lead to higher inflation and slower economic growth if this trade war lasts too long. It wouldn't make sense for the Fed to cut interest rates right now because it will likely cause inflation to go up even higher. Recently, the market has started recovering a bit because Donald Trump is starting to pivot, pausing his high tariffs for 90 days and easing some of his reciprocal tariffs on specific items. Here's why he's willing to ease some of his tariffs. The 10-year and 30-year US Treasury yields have increased even more since Trump announced his reciprocal tariffs. This is the opposite of what he initially intended to accomplish. Meanwhile, the US dollar has weakened a lot since the beginning of the year. The S&P 500 and Nasdaq 100 are still in a major correction, and many stocks are deeply undervalued. Inflation will likely increase in the upcoming months because the cost of importing goods from China and other countries has increased significantly. The US economy is expected to slow further in the coming months because of this ongoing trade war. High tariffs are impacting many American businesses that rely on imported goods from China and other countries. At the same time, this trade war is discouraging many businesses from investing. Ultimately, the high costs from tariffs are passed on to consumers, meaning American consumers are the ones paying for these tariffs. All these negative effects on the US economy suggest that this self-inflicted trade war is not sustainable. I believe Trump understands this. This is why he's willing to start de-escalating this trade war, particularly with China. This is also why I expect the market to continue recovering in the upcoming quarters. There are several recent events that suggest this trade war will likely ease further going forward. First, Trump stated that he has no intention of firing Powell, at least for now. He seems to understand that firing Powell would be catastrophic for the US dollar, US stocks, treasury yields, and treasury bond prices. Of course, Trump doesn't want the US dollar or treasury bond prices to fall further. Maintaining an independent US central bank is very important for both equity and bond investors. Second, according to the Wall Street Journal, Trump has already met with CEOs from the largest retailers including Target, Walmart, and Home Depot. They warned him that his tariffs, especially those on China, will likely lead to higher prices for consumers. Third, Trump's closest advisor Elon Musk made a statement during an earnings call. He believes that lower tariffs are generally a good idea for prosperity. He has advised Trump that lower tariffs are better than higher tariffs. But of course, the final decision will still be up to Trump. This is my prediction. Considering these recent events and economic factors, I believe we can expect that Trump will ease his reciprocal tariffs more in the upcoming months. The US is already negotiating new trade agreements with other countries. More importantly, the trade war between the US and China will eventually de-escalate because the current high tariffs are not sustainable for both sides. Eventually, the US and China will reach new trade agreements, so we just need to be patient, continue buying the dip, and wait for the market to recover. Now, I came across this while I started making this video. The bears always like to say this time is different. However, in reality, the S&P 500 has always recovered much more after every major crisis and bear market because the US has the strongest economy in the world, the most productive and innovative companies, strong employment, stable inflation, and an increase in GDP over time. I've said this several times before. I believe the market will recover by the second half of this year, which will be the best case scenario, or by next year, which will be the worst case scenario. Typically, most bear markets tend to recover in about 1 or 2 years. As a long-term investor, I think it's very important to stay the course, stay invested at all times, ignore all the market noise, keep buying the dip whenever great companies are undervalued, and keep holding for the long term. This way, our stock portfolios can grow much more over the long term. Let me show you my investing strategy here. This is one of my investment accounts. I have 7 or 8 investment accounts that have almost the same stocks. All of them have the same investing strategy. Right now, my long-term investing strategy is to keep buying wonderful businesses at wonderful prices. This means I like to buy the best businesses and buy their shares only when they're likely undervalued. Then I just ignore all the market noise and hold them for the long term so they can grow much more over time. Right now, most tech stocks are still deeply undervalued. I plan to buy more Magnificent 7 stocks, excluding Tesla. I would like to buy back Apple and buy more Nvidia, Google, Microsoft, Amazon, and Meta over time. If Visa and MasterCard are deeply undervalued again, I will buy more shares. I had SPGI stock in my portfolios before, but I sold it for a quick profit. If SPGI becomes deeply undervalued again, I will likely buy it back later on. Let's go back to S&P Global or SPGI stock. I would like to talk about S&P Global's biggest risk and financials first. At the time of making this video, I believe there are 3 main risks we should consider. First, S&P Global's indices business is highly dependent on the global economy, particularly the US economy. The company earns a large portion of its revenue from fees that are linked to the amount of assets invested in the S&P 500 and other S&P indices. During recessions or large market corrections, fewer people invest in ETFs and mutual funds that track the S&P 500 and other S&P indices. Moreover, bear markets significantly reduce the assets under management or AUM tied to the S&P 500. This results in lower values for S&P Global. Second, S&P Global's credit ratings business also heavily relies on the global economy, particularly the bond issuance and refinance market. S&P Global generates most of its revenue by providing credit rating services to companies and organizations that issue bonds to investors. Typically, during large recessions, market corrections, or periods of high interest rates, many companies and large organizations tend to reduce their bond issuance and bond refinancing. Of course, this leads to lower value for S&P Global's credit ratings business. Third, S&P Global assumed and issued a large amount of debt after it acquired IHS Markit back in 2022. Here, you can see that S&P Global's total debt has increased substantially since 2022. At the time of making this video, S&P Global has around $1.69 billion in cash and short-term investments. In comparison, its total debt, including operating lease liabilities, is around $12 billion. This means S&P Global's net debt is around $10 billion, which in my opinion is a lot. I like companies that have little or no debt, or at least have the same amount of cash as debt. S&P Global is planning to pay off its large amount of debt over time while still returning 85% or more of its free cash flow to shareholders through dividends and share buybacks each year. Eventually, S&P Global will likely need to slow down its dividend growth and share buybacks whenever it needs to pay down its debt. In terms of other financials, S&P Global has had very consistent revenue growth, operating income growth, operating cash flow growth, and free cash flow growth over the years. S&P Global has an asset-light business model that does not require a large amount of capex each year. The company mainly provides credit ratings, market intelligence services, indices, benchmarking services, and commodity insight services. This is why the company can generate a large amount of free cash flow each year, grow its free cash flow consistently over the years, and only require a very small capex each year. S&P Global also has had consistent EPS growth and free cash flow per share growth over the years. At the same time, the company has also been returning more capital to shareholders through dividends and share buybacks over the years. The company has been increasing its dividends consecutively for over 51 years, even during market downturns. This shows that the company has a very stable and strong business that generates consistent revenue growth, operating income growth, and free cash flow growth over time. Not many companies can grow dividends consecutively for over 50 years. S&P Global only needs to invest a small amount in capex each year. This allows the company to return most of its free cash flow to shareholders through dividends and share buybacks each year. This year, according to management's guidance, the company intends to return 85% or more of adjusted free cash flow to shareholders through dividends and share repurchase. The board of directors has authorized a quarterly cash dividend of 96 cents, marking the 52nd consecutive year of dividend increases for the company. Additionally, the board has authorized the repurchase of shares totaling up to $4.3 billion. This is very important because this guidance suggests that S&P Global's dividend growth won't be impacted much even if the US heads into a recession. Let me show you this revenue by business segments. S&P Global has these 5 major business segments: indices business, mobility business, commodity insights, ratings business, and market intelligence analytics business. S&P Global tends to earn the most revenues from market intelligence business, followed by credit ratings, commodity insights, mobility, and indices. However, in terms of profits, you can see that credit ratings and indices businesses tend to generate the most operating profits, followed by market intelligence and commodity insights. Here is the important part to know. If we look at S&P Global's revenue types, you can see that around 60% of the company's total revenue is from subscriptions and asset-linked fees. This is very important because it shows that the company will still earn very stable subscription revenues from market intelligence, commodity insights, and mobility insights, even when there's a huge market downturn. Additionally, even when there's a market downturn, the company will still earn asset-linked fees from ETFs and mutual funds that track the S&P 500 and other S&P indices. This is why the company can maintain and keep growing its dividends consecutively for over 50 years, even during market downturns. S&P Global is a very mature business, with revenue typically growing in the mid to high single digits each year. Looking ahead, management expects that the company's operating margin to continue improving over time. This margin expansion will be driven by ongoing synergies from the acquisition of IHSS Market in 2022. Moreover, the company plans to keep reducing expenses, acquiring other businesses that generate consistent free cash flow and high margins, and occasionally selling non-core businesses that have limited growth potential. Now, let's talk about S&P Global's long-term growth prospects and the expected growth rates going forward. According to this consensus forecast, S&P Global's revenue will likely grow between 5% and 7% over the next 3 years. S&P Global's most important businesses, including credit ratings, market intelligence, commodity insights, and indices, are very mature businesses. They tend to grow at mid to high single-digit growth rates in most years. So I think it's reasonable to expect that S&P Global's total revenue will grow by around 5% to 7% each year over the next 3 years. In comparison, the company's EPS will likely grow much faster in the low teens over the next 3 years because the company is expected to achieve more operational efficiency, reduce expenses, and focus on core businesses that are more profitable. Overall, S&P Global has exceptionally high margins. For example, at the time of making this video, S&P Global's operating margin is around 40%, while its free cash flow margin is around 39%. The only downside I can see is that S&P Global's businesses are very mature, so I would not expect the company to have high growth rates over the next 3 to 5 years. At the time of making this video, the company's Q1 earnings have not been released yet. However, management has already provided this revenue guidance for this year. They expect that the market intelligence business to grow between 5% and 6.5%, the credit ratings business to grow between 3% and 5%, the commodity insights business to grow between 7% and 8.5%, the mobility business to grow between 7% and 8.5%, and the indices business to grow between 8% and 10%. Additionally, all of these businesses are expected to maintain high adjusted operating margins ranging from approximately 33% to as high as 70%. Overall, management expects that the company's revenue to grow between 5% and 7% this year, with an operating margin ranging between 41.5% to 42.5%. But here's an issue we should consider. Management provided the revenue guidance I shared earlier before Trump announced his reciprocal tariffs. Management's assumptions included real GDP growth of 3%, US CPI inflation of 2.3%, and low single-digit bill issuance growth this year. Trump's trade war and reciprocal tariffs will likely lead to higher US inflation and slower economic growth. Moreover, ongoing uncertainty in the market due to this trade war may cause actual bill issuance growth to fall below expectations this year. So S&P Global's revenue growth will likely come in at the lower end of its 5% to 7% guidance range for this year. Over the long term, I believe there are several secular trends and growth drivers that will benefit S&P Global. First, S&P Global has a huge economic moat in the credit ratings market. S&P Global Ratings is currently the largest credit rating agency in the world. Together with Moody's Investor Service and Fitch Ratings, it dominates the industry. These three credit rating agencies control over 90% of the global market. It's extremely difficult for new competitors to enter the credit ratings market because they must be well recognized among businesses and investors around the world. They also need to be registered as a nationally recognized statistical rating organization or NRSRO and gain approval from the SEC, which is a huge regulatory hurdle. This is why it's nearly impossible to disrupt S&P Global Ratings. Companies issuing or refinancing bonds typically rely on S&P Global Ratings because investors trust the credit rating company. Now, by paying S&P Global Ratings for credit assessments on bonds and bank loans, companies can typically save millions or even billions of dollars because trusted ratings will lead investors to demand lower yields and thus reduce the borrowing costs for the company that wants to issue bonds and loans. Let's consider this. Companies and large organizations around the world will continue to issue more bonds, high-yield loans, bank loans and structured finance products because they need to borrow more to finance their growth and their projects. These companies need to refinance their bonds and loans whenever they mature. In addition, they need S&P Global ratings to assess their loans each year. This means S&P Global's credit ratings business will continue earning high revenues and operating income over time because the global bond market is expected to grow much more over time. Again, the biggest risk is that S&P Global's credit ratings business is entirely dependent on the bond market and the global economy. Companies tend to reduce their bond issuance and refinancing whenever interest rates are too high and whenever there's a large economic downturn. Last year, S&P Global's bill issuance grew much faster than expected. This year, we can expect that the company's bill issuance growth will likely slow down significantly because of Trump's trade war and potentially slower economic growth. Second, the indices business contributes a large amount of operating income to S&P Global each year. As I mentioned earlier, the company earns more asset-linked fees whenever the S&P 500 appreciates in value and whenever investors buy more ETFs, mutual funds, and other products that track the S&P 500 and other S&P indices. More investors are choosing passive ETFs and mutual funds that track the S&P 500 because most actively managed funds underperform the index over the long term. This means S&P Global will continue earning higher asset-linked fees from the S&P 500 over time. However, the biggest risk is that these asset-linked fees tend to decline during market corrections. Third, I believe the market intelligence business has a strong advantage over other platforms because S&P Global holds a large amount of proprietary data that's tied to the S&P 500 and other S&P indices. Professional investors, money managers, investment banks, and commercial banks are willing to pay billions to access S&P Global's proprietary datasets, analytics tools, and credit rating services. So over the long term, as long as the global equity markets continue to grow, we can expect both S&P Global's indices and market intelligence businesses to keep growing over time. Let me show you this consensus forecast from Seeking Alpha so you can see S&P Global's expected growth rates going forward. Over the next 5 years, S&P Global's total revenue is projected to grow by around 5% to 7% annually. I believe these growth rates are reasonable given that most of S&P Global's businesses are already very mature. In terms of EPS forecast, S&P Global's EPS is expected to grow around 8% to 12% annually, which is higher than the company's expected revenue growth rates. Again, management expects that the company will achieve higher operational efficiency and higher margins over the next several years. Let's take a look at S&P Global's valuation. Historically, SPGI's PE was always above 30 over the past 5 years. This year, SPGI's forward PE is expected to be around 28. Next year, SPGI's forward PE is expected to drop to around 25. I believe these 4 P's suggest that SPGI is either fairly valued or slightly undervalued now. Right now, I'm building this investing app with a friend. This is a preview. We're trying to fix as many bugs as possible and improve the UI before releasing this investing app to everyone. The orange line is S&P Global's fair value over time. The blue line is its share price, and these dotted lines are price targets. At the time of making this video, S&P Global is trading slightly below its fair value. Based on our calculations, S&P Global's fair value should be around $526 per share. In comparison, Annon's average price target is much higher, around $580 per share. Our price target is much more conservative at around $517 per share. Of course, the best time to invest in S&P Global is when it's well below its fair value line. This means I believe S&P Global or SPGI stock is either fairly valued or slightly undervalued now. I also calculated S&P Global's intrinsic value using this intrinsic value model. I always use this intrinsic value model to calculate each stock's intrinsic value, so I will know when a stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic value model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define S&P Global's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 9.5% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the expected growth rates I talked about earlier, I believe S&P Global's value will grow a compound annual growth rate or CAGR between 5% and 7% each year over the next 5 years. My base case scenario is that S&P Global will continue growing at around 6% annually over the next 5 years. I used a long-term growth rate of 6% to calculate the terminal value. If you want to be more conservative, you can use a lower long-term growth rate to calculate the terminal value. Over the next several years, I believe S&P Global's free cash flow margin will improve over time. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we forecast that S&P Global's value will grow at a CAGR of 5% each year over the next 5 years. Then S&P Global's intrinsic value should be around $156 billion for the entire company, or $504 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we forecast that S&P Global's value will grow at a CAGR of 6% each year over the next 5 years. Then S&P Global's intrinsic value should be around $163 billion for the entire company, or $529 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we forecast that S&P Global's value will grow at a CAGR of 7% each year over the next 5 years. Then S&P Global's intrinsic value should be around $171 billion for the entire company, or $554 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, S&P Global's intrinsic value should be around $529 per share. I also use a forward sales valuation model to estimate S&P Global's intrinsic value, which should be around $161 billion for the entire company, or around $521 per share. If we take the average of both valuation models, I believe S&P Global's intrinsic value should be around $525 per share. Morningstar has given S&P Global a much higher fair value, around $540 per share. This means I believe S&P Global or SPGI stock is slightly undervalued now. So will I buy S&P Global stock? My answer is yes. I plan to buy back the stock once it becomes even more undervalued. Ideally, I would like to buy it back when it's undervalued by 10% or more. As I mentioned earlier, I previously sold the stock for a quick profit and reinvested those funds into other high-growth tech stocks. I like S&P Global's businesses and its long-term growth prospects. Specifically, it has a strong economic moat in the credit ratings and indices businesses. It's extremely hard for new competitors to disrupt S&P Global ratings and S&P Dow Jones indices. The biggest downside is that S&P Global is a very mature company, which means its annual revenue growth will likely stay in the mid to high single digits over the next several years. Now, all these are only my opinions and my analysis that's based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.